Hello and welcome. When it comes to investing, we're often told we have to choose. Do you want to be safe or do you want to be aggressive? The conventional wisdom says you can't be both. You either accept low returns for safety or high risk for the chance of high returns. But what if I told you there's a way to have your cake and eat it too? A strategy that lets you protect the vast majority of your wealth from any catastrophe while simultaneously giving you a lottery ticket-like exposure to massive, asymmetric gains. This isn't a new, trendy concept. It's a powerful, time-tested approach popularized by the renowned investor and author Nassim Nicholas Taleb. It's called the Barbell Strategy, and in this video, we're going to break down exactly how it works, why it's so psychologically brilliant, and how you can implement it in your own portfolio. Let's redefine what it means to be a balanced investor. So, what exactly is the barbell strategy? The name comes from the object itself. A barbell has almost all its weight on two opposite ends, with very little in the middle. The barbell strategy applies this same principle to your portfolio. Instead of putting your money in a moderate mix of stocks and bonds, like a traditional 60-40 portfolio, you split it into two extreme, opposing halves. Let's look at the first end of the barbell, extreme safety. This side makes up about 85 to 90% of your portfolio. This portion of your wealth is placed in the safest, most conservative assets possible. We're talking about things like US Treasury bills or bonds, FDIC-insured high-yield savings accounts, short-term CDS, or money market funds. The goal here is simple: capital preservation. This part of your portfolio is designed to be virtually immune to market crashes, economic recessions, and those unpredictable black swan events. This money is your fortress. You accept low returns in exchange for near absolute safety. Now for the fun part, the second end of the barbell, extreme risk. This is where you allocate the remaining 10 to 15% of your portfolio. This portion is dedicated to highly speculative, high volatility assets that have what's called asymmetric upside. That means you have a small chance of making a very, very large return. Think about things like options contracts, especially out-of-the-money calls, or speculative growth stocks and small-cap companies. For some, it might be early-stage venture capital, angel investing, or even cryptocurrencies if you have the stomach for it. The goal of this portion is optionality and explosive growth. You are fully aware that this entire portion could go to zero, and you're okay with that because it's money you can afford to lose. The key to the entire strategy is that there is nitrogen monoxide middle ground. You don't invest in moderately risky corporate bonds or stable blue-chip stocks. You are either in ultra-safe assets or high-potential, speculative ones. You're either all in on safety or you're taking a calculated shot at the moon. Now, the true genius of the barbell strategy isn't just mathematical, it's psychological. It solves the two biggest behavioral problems that investors face: the fear of losing everything and the fear of missing out, or FOMO. First, it eliminates ruin risk. Knowing that 85 to 90% of your net worth is completely safe in treasuries or cash allows you to sleep soundly through any market storm. Imagine a 50% market crash in a traditional portfolio. That would be devastating. But with a barbell, that crash would only impact your 10% speculative portion. This means your overall portfolio would only be down about 5%. That is a manageable, non-panic-inducing loss. You are protected from catastrophic failure. Second, the strategy harnesses FOMO productively. We all get that itch. We see a stock or a crypto coin skyrocketing, and we feel that intense pressure to jump in. Instead of recklessly throwing your life savings into a risky investment, because you're afraid of missing the next big thing, the barbell gives you a designated play portion of your portfolio. This is your sanctioned outlet for speculation. It satisfies that desire to take a shot on something without jeopardizing your entire financial future. This creates a virtuous cycle. Because you aren't terrified of a crash, you are far less likely to panic sell your speculative assets during a downturn. In fact, you might even see a crash as a buying opportunity for your risky end. This emotional stability is a massive advantage over investors who are constantly stressed about their supposedly balanced portfolio. You're no longer a slave to the market's every whim. So, how do you actually build your own barbell portfolio? Implementing this strategy is surprisingly straightforward. Let's walk through a sample portfolio for an investor with a $100,000 nest egg. First, you build the safe end. Let's decide to allocate 90%, which is $90,000, to this side. Your mission here is maximum security. For example, you could put $50,000 in a Treasury money market fund and the other $40,000 in short-term Treasury ETFs. This $90,000 is your anchor. It will grow slowly, probably just keeping pace with inflation, but its principle is extremely safe. This is the foundation that lets you sleep at night. Next, you build the risky end with the remaining 10%, which is $10,000. This is where you get to be creative based on your own knowledge and risk tolerance. There are a few ways to approach this. Option 1 could be for the stock picker. You could invest the $10,000 in 2 or 3 high-conviction, high-growth companies that you've thoroughly researched. Option 2 could be using leveraged ETFs. You could allocate a portion to a leveraged NASDAQ 100 ETF for amplified tech exposure. Option 3 is more of a venture capital style. You could split the $10,000 into 20 different $500 baits on various microcap stocks or early-stage projects, knowing that just one winner could pay for all the losers, and then some. But there is a golden rule for this risky end. You must be mentally prepared to lose this entire 10%. If the thought of that $10,000 going to zero makes you queasy, then you need to reduce the percentage. Maybe it's 5% for you, or even 2%. The strategy only works if you're truly comfortable with the potential loss on the risky side. Now, who is this strategy not for? It's not a one-size-fits-all solution. It's generally not ideal for investors with a very short time horizon, say less than 5 years. It's also not for investors who cannot emotionally handle seeing their speculated baits fluctuate wildly or even go to zero. And finally, it might not be the best fit for investors who are still in the early, high-growth accumulation phase of their life and need more market exposure to build their initial wealth. So let's quickly recap. What is it? The Barbell Strategy is a portfolio split into 2 extremes, 85 to 90% in ultra-safe assets and 10 to 15% in highly speculative assets. Why does it work? It provides catastrophic loss protection while offering unlimited upside, and maybe most importantly, it creates immense psychological stability for the investor. How do you start? You decide on your personal safe versus risky split, park the majority in treasuries or cash equivalents, and then use the small remainder for calculated, high upside baits that you're comfortable with. The Barbell Strategy is a declaration of independence from the false choice between safe and aggressive. It acknowledges that the future is unpredictable and that the biggest gains often come from unexpected places. By explicitly planning for both disaster and triumph, you create a portfolio that is not just diversified in assets, but diversified in outcomes. It's the ultimate way to be both a turtle and a hare. Slow, steady, and protected with the bulk of your wealth, but lightning fast and opportunistic with a small part of it. Thank you so much for watching. If you found this breakdown of the Barbell Strategy helpful, please give this video a like and subscribe for more deep dives into smart investing. See you next time.